Hi, one and all present here. Good evening to all. So let's start this webinar. So before diving into the webinar, so I am Shivshankar. I am part of CloudBanking. So I am a pre-sales consultant, and today, before getting, let me give why we are conducting this webinar and what this CloudBanking does. Let me share my screen and quickly show a quick presentation. So I hope everyone able to see my screen, right? Can speakers confirm this?
Yeah, sure.
Okay. So cloud banking is a end-to-end digital banking platform where you can manage your end-to-end banking services, starting from the loans to savings, cards, receipts, everything can be managed using our application. So we have been named as an easy to use software in the GT2 crowd, and we have been continuously uh, named as a high performer. And we also got an award for an enterprise lending platform. And our application has been supporting 10 type of different loan products, starting from both secured as well as the unsecured loans, and then we are able to process around 15 million applications as of now, and that's rapidly growing every day. And we also have 50 plus clients across 10 geographies. We have major customers in India. Apart from India, we also have presence in 9 other countries as well. So what cloud banking offers? So cloud banking offers a variety of services in this financial segment. So we provide a digital onboarding application which available in web as well as the mobile version, where it will be completely flexible to onboard and digitize your customer onboarding part. So starting from the registration of the borrower, either the customer self services or if your agent onboard the customer, everything can be seamlessly integrated with varieties of API to automate the entire customer onboarding process. And then we provide a loan origination system where complete KYC, credit bureau checks, and bank statement analysis, financial statement analysis. So for every analysis and activities, we have integrated with the APIs, and we provide a single platform where you will able to seamlessly disperse your loan. And then we also have a custom rule engine, so which automates your and also makes your life easier on the underwriting part. So this rule engine will help you to completely configure the underwriting parameters as per your needs. So you can configure from the data that we are getting from variety of sources like credit bureaus, bank statements, and financial statements like IT or GST or balance sheet, and other details that you are collecting from the customer can be given as an input to the rule engine, and you will able to segment, and you can give a weightage for each factors that you are going to consider for underwriting a customer. And you will able to generate a custom scorecard, and you can make a quicker decision scam report, and deviation mechanism. Everything can be configured, and we can make a quicker decision using our rule engine. And then we also provide a loan management system where the complete loan servicing part takes care. So once the loan get dispersed, so the complete repayment tracking, NPA management, GST for fees and other steps, and complete tracking of the overdue loans, everything can be done. And whenever you want to send an SMS or alerts for the repayments, links for the payments, and direct debit collections, everything can be managed using our management system. And also we have 50 plus reports to give both regularization reports, as well as you can have a different reports on the loan perspective and customer perspective, and you can send the statement of loan accounts. Everything is available in our loan management system. And then this recent emergence of co-lending management, if you want to get into the um, co-lending with the banks or any NBFCs, we provide a co-lending management to seamlessly manage the repayment schedules of three, and your sharing portfolio 70-20 ratio or 80-20 ratio. Everything can be configured, and you will able to manage that co-lending. And here comes to the topic that we are going to discuss today about the embedded finance. We also provide a BNPL management system where it can be acted as an embedded finance. We provide a seamless integration with any e-commerce sites or any other sites that you want to tie up. You will able to do the onboarding from there, and you will able to seamlessly process applications using our BNPL solution. And then with the recent RBI regulation, you need to submit the data to the central KYC portal. That's a SSI portal. So we provide a CKYC as a API services where you will able to do the complete retrieval of data and submission also using our CKYC solutions. So this, as I mentioned earlier, we support 10 plus loan products. So here are the few products that we have mentioned. What are our application supports? So using our cloud banking, what you can achieve, you can definitely increase 10x growth in your productivity. So then you can also follow Mr. Mani Parthasarathi, our founder, in the LinkedIn. So he will be daily posting and updates about the industry and what's the recent trends happening. You can follow his LinkedIn, and you can also follow the hashtag Money Speaks Money, where you can get regular updates on the industry sharp at 11 a.m. And we are also created the WhatsApp group where you can get the daily digital lending updates. So Rajit will be posting that on the chat. You can use that link in the chat, and you can join our WhatsApp group. So every day at 12 p.m. you will be getting updates and what are the recent events, or what are the updates in the industry. And our we will be conducting monthly webinar series as well. So you can also get our updates on this WhatsApp group. You can also use of it. So all our purpose is to enable technology, not only enable technology, but also we want to serve the industry, and we want to give knowledge to the all the NBFCs and industry veterans over here. That's why we conduct these webinars. We post regular updates. So all is to share the knowledge with the industry. So with this note, let us get into the today topic. So today we are going to discuss on the embedded finance. So while we see embedded finance, so what is this embedded finance is all about? So let's imagine. So you are going to purchase or purchase a product in the Amazon, or you are going to book a ticket in IRCT's website, or anywhere in a Ola or a Uber. Anyways, you are going to book a ticket, or you are going to purchase anything. So once you go to the payment, you can hear, so you can see a tab called buy now pay later, or you can have a sudden pop-up. So you can avail a quick loan for this. So that's where this embedded finance comes in. So it's enabling every company to be a fintech. So if you are a non-finance company, if you want to get into lending, you can tie up with any banks or NBFCs, and you can also get into this fintech segment. It's not only enabling the technology advancement, it is also says it's transforming the social economic transformation. So let's dive deeply. So you can see, if you get into the Amazon has tied up with the ICICI, and it's offering its savings, and you can also get the loans, and you can also create the credit limit within that. And HDFC has a tie up with the Ola, and is using the cards, and they are, it not only it gives you the wide variety of customer base, and you can utilize this tying up with any of the e-commerce sites or this ticket booking sites. The market says in India, around 60% of the e-commerce sites or ticket booking peoples are using these services. And globally, it says around by 2025, it will have a 230 billion of market potential.
I think
So with this note, let's get hear from our speakers. So we have Aditya, a founder of Niro Money, as a guest speaker, and Money will be the moderator for this today webinar. Let's hear from them.
thanks a lot, Shiva. I think that was a detailed introduction. So thank you so much. Aditya, thank you so much for joining as a speaker in this webinar. Can you please give a bit introduction about you and your company?
Sure, Mani. Thanks for having me. Hi everyone. Good evening. Good to be here. My name is Aditya, and as Shiva and Mani said, I'm a two-time fintech entrepreneur. I've been in the space for about a decade now. My first company that I founded was a company called Cubera, a direct-to-consumer digital lending platform. One of the earliest consumer lending platforms in India. Started in 2015, ran it for 4.5 years. Eventually sold it to Incred, which is a mid-market NBFC, recently turned unicorn, as you may have read in the news. At Incred, I ran the entire consumer lending business for a year. That was about an 850 crore book. Ran it from 2020 to 2021 March, and then moved out and now run a embedded consumer lending platform called Niro. At Niro, we essentially do what parts of what Shiva was talking about is we work with consumer internet platforms, and we help consumer internet platforms essentially launch white labeled credit products. These products range from cross-sell products, which is sort of the way a cred sells a loan or a grow sells a loan to its end consumers, which doesn't have anything to do with the end use on the platform per se. Two very deeply contextual credit products, which, as Shiva was saying, you may use to finance a purchase or consummate a transaction on an e-commerce platform. Our vision essentially is that every consumer internet platform wants to and needs to leverage and harness the power of financial services. And Niro is a conduit to be able to do that. We work, as I said, with medium to large size consumer internet platforms. Names include MyGate, ShareChat, Snapdeal, Quicker, Housing.com. And we white label and embed credit programs into their ecosystems. We are about a little over 2 years old. We've raised 2 rounds of capital. We are about 200 people. We work with 7 platform partners, some of whom I mentioned. We work with 5 lending partners, including IDFC Bank, PayU Finance, Muthoot FinCorp, and a bunch of others. We originated about 800 crores of loans till date, have a loan book of about 575 crores outstanding at the moment, originating about 75 crores of loans per month. So yeah, that's my short background and about Niro.
Perfect. I think this gives a crisp about what you and your company does, Aditya. Thank you so much. Thanks for being here. So let's get into the webinar, Aditya. So the audience, what we have right now is, of course, there are NBFCs, new age startup fintechs, and there are a few persons from the banks also, right? So these are all the audience right now. And so let's start with some basics, right? So can you give what do you mean by embedded finance? Because it's most commonly used word, right? So maybe if you can give us an in-depth information about what is embedded finance and all.
So I mean, it's a very vast question and a very vast topic, Mani, as you correctly said, right? And I think the term is used and misused somewhat and used interchangeably for a bunch of different things. But at its core, right, it's really about bringing financial services into points where customers are having what are otherwise traditionally non-financial services experience, right? So this could be in the form of a BNPL type checkout, which I was talking about, where at the end of the day, if I'm paying for food on Swiggy or Zomato, or if I'm paying for a cab on Ola, I have a postpaid product that I can use to effectively pay in one click, which is more of a convenience product rather as opposed to a credit product, right? Many people use these products not because they require that 2,000 rupees, 3,000 rupees of credit for 15 days, but because it enables convenience. It's a one-click checkout. Once a month, I can go back and clear all my bills off, right? But so that's one form of it. Another form of it is, for example, as I mentioned, what the likes of Cred Grow and do and what Niro enables, which is enabling consumer internet platforms, right, that have fundamentally 3 large assets, which are data, distribution, and engagement, to distribute credit products and other financials. It doesn't only have to be credit, right? But credit and other financial services products to their end consumers, right? That's a second avatar. And what they drive through this largely is monetization, right? So they're able to drive monetization at scale because at the end of the day, consummating a regular transaction, for example, on a Snapdeal, where the average transaction value may be under 500 rupees, their net margin may only be 15%. So they're making 60 rupees on our transaction there. Whereas by distributing one loan or one card, they have the potential to generate maybe somewhere in the range of 2,000 to 5,000 rupees of revenue per transaction, right? That's the second form of embedded finance. Third, facilitating larger ticket commerce where you're actually promoting affordability. So this is the likes of what Bajaj have been doing for a very, very long time, right? And saying that, hey, you would have bought a 8,000 rupee Oppo phone I am now enabling you or giving you the ability to buy a Pixel phone of 35,000 rupees because you can pay it over 12 months on EMIs, right? Or you're going on holiday and you're on Make My Trip, and I'll give you the ability to pay in 3 or pay in 6 and pay in 9, right?
Mm-hmm.
So third type of embedded finance is where essentially there is larger ticket consumption that's happening, and the platform embeds credit products inside their journeys, which enable the products to become more affordable to a end consumer. A fourth type can be contextual cross-sell credit, right? Which is that today it may still be a loan of some sorts, but if at the time that I'm going to pay my son or my daughter's school fees, if I know that there is a credit line that's available for me to be able to pay using the line, and as opposed to paying in cash or the settling the entire amount up front, that again eases up my cash flow for me, right? So it's a combination of affordability, or it may just be that my school is giving me a 3% rebate for paying the fees up front. So I'd much rather pay, this in installments over 3 months, potentially at a very, very low cost, because I'm getting that upfront discount, right? It can be, I think Shiva used this example also, you checking out using a co-branded card, or signing up for a co-branded card when I'm about to make a purchase, because there's a product incentive or a discount which incentivizes me to do it, right? So it can be any one of these things, right? And many, many other examples also. But at its core, it is about, broadly speaking, brands. You see it much more on tech brands, and that's why I said tech platforms, right? Consumer internet platforms like the names that I mentioned, because it's often easier to embed in digital journeys as opposed to analog journeys. But at its very core, the idea is empowering brands/platforms to embed financial services of some sort into their sort of user flows or into their platforms.
Got it. So in this webinar context, right, let's focus on embedded lending, right? So because Niro is into that, right? So let's get into that. Who are all the stakeholders of this embedded finance? What are all the different types of stakeholders, and what is their responsibilities, and what is their benefit out of it?
So Mani, one is you have the person who typically owns the customer, the data, and the distribution, right? Now that in most cases will end up being what loosely we refer to as the brand. But in the case of, let's say, in our Niro's kind of embedded consumer lending, it's the consumer internet platform. Easiest way to think about it is any mobile application that you have installed on your smartphone, right? So think of that entire universe of consumer internet platforms. And if you want to think about the offline world, some people may be a bit more familiar with that side of the world. Any brand which has access to customers, which has access to their data, which has engagement with these consumers, right? Data distribution and engagement. So that's one stakeholder, and their responsibility essentially is to act as a catalyst for the customer to avail of this financial product, number one. Number two, to integrate that product, whosever product it may be, into their journeys and their ecosystems, right? So broadly, they're responsible for making sure that discovery happens and making sure that offtake happens. Both of those are their responsibility. So that's the first, which is loosely referred to as the brand or the consumer or the platform in this case. The second stakeholder, and let's keep Niro aside for a second. The second stakeholder is the person that's responsible for building the product and technology, right? Now that could be a CloudBankin, that could be a Finbox, that could be a Niro, but somebody who at their core are responsible for building the pipes between where the money is eventually going to come from, facilitating the underwriting decision to say that you will give money a product and not give Aditya a product, right? The product design, the user journey, etc., all of those things, right? That's the second bucket. That's the second set of stakeholders. In many cases, those end up being fintechs. Fintechs that specialize in doing that, right? Could be an M2P, could be a CloudBankin, could be a Finbox, could be a Niro. The third is, and there are players who do multiple things, but the third is the person typically facilitating the underwriting. Right now, it can be the lender, the person who's actually providing the capital, and can be this fintech that we just talked about.
Got it.
So either the underwriting rests with the fintech in this case, which does both the tech, the product design, as well as the underwriting and sometimes even servicing and collections as an LSP, or it belongs to the lender. right? So the lender then becomes the third player in the ecosystem, which is the balance sheet, typically bank or NBFC. You will find examples where lenders are competitive in offering products to the brands that are A, competitive, and B, frictionless, right? Examples of this are what IDFC does with the Grow or a Cred, what Aditya Birla does with used to do at least until recently, and still does at a smaller scale now with a Paytm. What a Lazy Pay and a Simple do, let's say, with a with a Zomato or whoever else. So, but essentially, these are the three stakeholders, right? You have the brands or the consumer internet platforms, depending on who you are. You have the fintech that's in the middle. Some underwrite, some don't underwrite, but all of them do the product design, technology, etc., etc. And the third is the supplier of capital. Now, the division of responsibilities, as I said, is somewhat fungible, right? You'll have arrangements in which I'll need 2 or 3 examples to bring this to life, right? You'll have examples where the consumer internet platform says, yeah, I actually understand the product, the lending product. Don't think about tech product. I understand the lending product. I understand how it needs to be embedded. I will build the front end experience, etc., etc. The fintechs, the lender says, hey, I'm actually willing to underwrite, right? And I know how to own this customer. I can collect, I can run the P&L profitably. In those cases, the fintech is largely just responsible for building tech. Right? It's the tech layer to connect A to B, which is lender to supplier. In many cases, though, in our experience, that doesn't really scale. Right? So the opposite extreme example is the platform says, look, I don't know what to do, right? At all. I can't build the experience. I don't know what the product look like. I don't know how to market it, nothing. The lender says, I'm only willing to provide balance sheet. I don't know how to take risk. I'm not underwriting these processes. I need bank statements for every customer on if I underwrite myself. So I'm not underwriting also. So the fintech ends up doing everything else, right? So in the case of Niro, for example, we design the product, we work with the platform to help market it, we build the technology, we bring the supplier of capital to the table, we do the underwriting, we do the servicing of the loan, and we do the corrections, right? So though the 3 players are brand/consumer internet platform, fintech in the middle, and supplier of capital, bank/NBFC on one side. But division of responsibilities vary in those 2 extremes. One where the platform and the brand, the platform and the balance sheet do a lot of heavy lifting. Fintech in the middle just does tech. Second model, which is Niro, where platform/brand and balance sheet do very little heavy lifting, and Niro actually does everything.
Okay, interesting. I think this stakeholders, right? Maybe if you can explain me on the journey. Say, for example, I'm a borrower. Okay, I'm a user who's using some internet-facing application. The moment when I click, say I need a credit, right? So if I need a convenience or whatever, right? Whatever reason I choose the credit option. So what actually run in the background? So from which stakeholder to which stakeholder, how it is moving, and if you can tell me the entire journey, and then finally we as a consumer we can only see that we've got the convenience, right? But in the background, a lot of things are happening, right? Maybe if you can give the sample journey till the end, maybe that will be a great help. Yeah.
Yeah. So typically, what happens? I mean, there are 2 models that to identify which set of consumers are eligible for what products. There are 2 ways that people work. One way is that you do a upfront run a batch process, right? Now again, depending on who's doing the underwriting, whether it's the middle fintech or whether it's the lender, either way, they will do some sort of data room exercise with the platform or the brand to say, look, you have these 10 million customers or 100 million customers. In our case, our largest customer has 200 million active customers, right? And you have this data on these consumers, and we will conduct some sort of data room exercise pre-facto, right? Either running our credit policies, or if the lender is taking the risk, our lender's credit policies. And we will upfront identify that, for example, we don't know who Mani Parthasarathi is, but MP001 should be eligible for this product at this price. Whether that product is facilitating checkout, whether it's a cross-sell product, whether it's a line of credit, irrelevant, right? But MP001, which they know is Mani Parthasarathi, is eligible for this product at this price, right? So the first way is you run a batch process in a DRE, in a what we call data room exercise, essentially to identify large batches of consumers that the platform then either can market to or show these offers to when they're inside the platform, right? Number 1. The second is where you do it real time.
Yeah, sorry to interrupt here. But all these consumer internet companies sharing this data is completely okay with, is they are getting their consent from the borrower?
So they don't share any data with us, right?
Okay.
So when we say a DRE exercise, essentially there is an encrypted data exchange that takes place between us and them. Where,
Okay.
as I said, all I know is it's MP001.
Got it.
Right now,
Got it.
they know that MP001 is Mani Parthasarthi, right? Or
Got it.
AK001 is Aditya Kumar.
Hmm.
So the PII is what they're not allowed to share, obviously, right? Unless their TNCs cover it, and most of their TNCs cover it, but they're not allowed to share. That stays intact. That's the sanctity of that is maintained with the platform, right?
Hmm.
What we get is essentially these hashed or encrypted data where we
Okay.
can run certain exercises, let's say, for example, with the bureau, et cetera, to identify which customers we should give loans to and not give loans to. The second thing that happens is the second mode of operations is largely in real time, right? So this
Okay.
is
Yes.
where I don't know who the customers are that are coming through the pipe. And now let's say money is on the on Make My Trip booking an international holiday, and they can then taking appropriate consent say, hey, I'm going to, by the way, share your data quickly with, in their case, they have a fintech subsidiary called Trip Money. I'm going to share your data with Trip Money, and I'm going to figure out whether or not I can fund this international travel for you, right? And if I can fund this international travel for you, then I will show that offer to you in real time, and the user can actually can avail of it, right? Now that process can be as simple as the lazy pay and simple experience, where all they do is pass a mobile number, and they within 30 milliseconds are supposed to get a response saying, hey, yes, no, right, and quantum. Or it can be the start of a loan type journey where they say, look, this is great, but because this is a 4 lakh international holiday, we need to verify your PAN card, right? We need to verify a few more details. We need to verify your address, right? And then the user goes through the onboarding process, where the user through that onboarding process then is either approved or declined for a given product, right? So those are the two ways that people typically engage, right?
One second.
Yeah.
Sorry to interrupt here, Aditya. So when it moves on to a lender, right? Say MP001 has been moved on to lender, and then lender said that, hey, money is not eligible for a loan. Okay, let's assume that. Okay, but still MP001 data is still with a lender A.
So ideally you want to cut all as much of that down to zero as possible, right?
Correct. Yeah.
So the whole point in the first model, right, where MP001 is not consented to actually data sharing and PII sharing and all of that, what you want to do is you want to ensure that if you've identified MP001 as a customer, unless you have a very, very valid reason, for declining it, you want to make sure that a vast majority of MP001s get the product. The second one is where the customer actually does not have a commitment from the lender, and it is actually Mani Parthasarthi saying, I want to avail this credit product. Right? And then the customer is appropriately sensitized to the fact that, hey, you are going to, I am going to share your data with this lender. This lender is going to check your eligibility. That's going to have an impact on your credit score because it's going to create what we call an inquiry, right? And you may or may approve or may be rejected, which is why in general, what you would have seen scaling is actually the first model, right? Where platforms and brands say, look, I want to do as much as possible upfront to try to minimize in-funnel rejections, right? Because once for two reasons. One, it's a bad customer experience. Secondly, if I'm marketing to somebody saying, I can fund your international holiday, and then that customer comes in and, this might be a customer who otherwise could have even ordinarily paid for it on their own, right? But because the financing option is available, they're availing it. And then if you reject the customer, I may lose my primary transaction itself.
Right.
So that becomes a little bit painful, right? Yeah, I mean, that's why the first model tends to be preferred. So what you find the largest, I would say, embedded lending platforms or people who offer embedded lending experiences for their own customers doing today, right? Their vast majority of them are in the first model.
Okay. Just to add on those questions, right? So the consumer internet-based companies, for this webinar, let's take one example because people around us may not be familiar with those terminologies, right, Aditya? Can you give me an example for consumer internet companies that you work with? sample use cases?
Yeah, sure. So I'll give you two, right? One is we work with the likes of a Snapdeal or a housing, and we sell cross-sell credit. Cross-sell credit means we do this DRE exercise with the likes of a Snapdeal or a housing to identify MP001 as a prospective candidate that we would like to give. And note, right? We would like to give credit to, as opposed to who may need a loan from us, who we would like to give credit to. Snapdeal or housing then reach out to MP001 saying, because they know that it's money, reach out saying, hey, money, as a Snapdeal customer, did you know you have 2 lakhs of Snap Cash or Housing Cash available for you inside your Snapdeal or housing mobile app? You open the app, you log in, it shows you the offer, you select the amount you want, you verify your PAN card, you enter your address, we recheck your real-time CIBIL. You complete NACH, which is you link your bank account, and you complete it, do an OTP-based e-agreement, and in most cases, you get money into your bank account. Okay. So that is an example of the way a cred sells credit, or a Grow sells credit, or a Paytm sells credit. Niro sells credit, which is a cross-sell product, right? It's nothing to do with the use case on the platform. What they're essentially doing is leveraging, as I said, their data, their distribution, and their engagement to sell credit to you. That's one example. The other side is we've got, let's say with a MyGate, right? We've got a line-based product where we've launched something, in fact, today, and those of you that live in MyGate communities, many of you should hopefully be seeing this very, very soon, right? Inside your MyGate apps, which says, if you pay your rent using MyCash, you can pay your rent for free and pay us back in 30 days at zero cost. So what money gets as a MyGate resident, depending on, again, money's data and credit history and all of that, is let's say a 3 lakh rupee credit line. And the activation hook for that, the value or the contextual value that we want to deliver to the end consumer is, hey, money, if you pay your rent using this, you can pay us back in 30 days at zero cost, right? But what happens in that case is we get you to activate this 3 lakh rupee line, in which you may only pay 40K rent, right? And you'll pay us back. But eventually the hope is that you will start to use the 40K line, the 3 lakh rupee line for other use cases, right? You could use it to buy furniture. You could use it to pay your security deposit. You could use it to pay your school fees for your children or anything else, right? It becomes a fungible line. But it's contextual to the extent that if you want to pay your security deposit or your rent, you can do it at a very, very low / zero cost, right? Similarly, looking at building something for an insurance platform, right, that has an average check size of about average transaction value about 30,000, right, where we can offer a zero cost product for people to use that credit line to pay for that premium, right, provided they've activated it in the past, right? So it becomes very powerful, driven by the context that we offer to those users in those cases, right? So yeah, one is, as I said, predominantly two, where where what we do with the likes of the MyGate, or what we plan to do with the insurance company. On the other side, what we largely do on the cross-sell side.
Correct. So I'm one of the users of MyGate. Okay. So assume that if in this webinar context, let's take 2-3 examples. One is Snapdeal that you have told, and then another is MyGate, right? So in the data room exercise, Snapdeal would have got a lot of customer base, right? So in the data room exercises, assume that I am one of the Snapdeal customer. I've done a transaction for the past 5-6 years. So I have a decent rating, right? So would you take only the traditional data, which is bureau data and the bank statement data, or you will also take what are the data, to put it in the right way, what are the data that you take it from the Snapdeal or MyGate to make sure money is a potential worth of borrower?
So the data in isolation, right? It tells us two things, right? What the data tells us is, one is, if you had to create, if you had 10 customers and you had to rank order them by affluence, it gives us an ability to do that, right? Because Money uses an iPhone 14, Aditya uses an Oppo phone, Rajit uses, a feature phone, right? For example, an extreme example. And Money lives in the center of Chennai, Aditya stays on the outskirts of Bangalore, Rajit stays in Bhilwara, right, in Rajasthan. It allows us to do some sort of affluence modeling to figure out that, look, in addition to the information we're getting on the bureau, can we figure out whether this person actually we'll be able to repay this loan out, right? That's the first thing it gives us. And we augment that data with data from the credit, right? So we bring in, derived attributes from the bureau, which allow us to, when we marry it with the platform data, gives us a decent sense of, okay, yes, no, maybe, right? The second thing that the platform data gives us is context, right? So today, if Money is looking at buying a second-hand car on Quicker, one of our customers, right? It allows us to tell the platform to market this product to Money as a used car loan as opposed to a personal loan, right? And Money's propensity then to actually take a loan from us increases substantially. Or if Aditya is buying, clothes for a 0 to 3 month old on first cry, right? Aditya's needs versus Money, right, who's buying a school bag for a kid who's about to start school, our needs are very different. I need money for maternity, you need money for potentially tuition fees, right? So it delivers the ability to us to theoretically at least, right, use these data for one, figuring out the affluence of the customer, and second, creating context as far as offering a product to you that makes more sense to you, right? As opposed to a product just saying, Money, take a loan, Money, take a loan, Money, take, because you get like 15,000 of those, calls every year anyway, right?
Correct.
So what differentiates it is our ability to reach out to you and say, hey, this is when you can actually get it, right? It's a big difference.
Super. I think wonderful answer. I think so based on that particular platform, respective credit products can be associated and then start selling so that it will be beneficial for both customers as well as lenders, right?
Correct.
Got it. By the way, switching gears, before that, participants who are hearing us, please feel free to post whatever questions that you have in the Q&A option or chat option. We'll take it up in the last 10 minutes. I think I didn't see the time, Aditya. It's going really good. So let's see. Let's take a few more questions from the audience. 1 second. So, so people are talking about ONDC. Okay, how this gonna impact this embedded finance, Aditya?
I mean, look, it's a really tough question, right? Because see, at the end of the day, what they're trying to do is say that in this case, we're talking about lending, right? So credit. Right. So any balance sheet that wants to give out loans, right? Now has access to the ONDC rails to say that any platform that has customers that are on the ONDC rails as well, can discover which products are available for them where, right? Now, by definition, right, ONDC intent for wanting the product under ONDC has to start from the customer, right? So ONDC cannot simply, a platform cannot wake up tomorrow and say, I'm going to send Money and Aditya Birla loan offer because I have Money on my app and Aditya Birla is a supplier of loans on the ONDC platform. Correct? You can't do that. Just like if you want to go and order a pizza, you can go to the section of the app that says food, pizzas, and then it'll show you all the available options, right? So to that extent, what it can impact quite materially, in my view, and I'm not an expert on ONDC, but the extent to which we've studied and the reason that we yet haven't built a plan to actually incorporate it into what we do is because what it will do is democratize Paisabazaar's business, right? Or Bank Bazaar's business, right? Paisabazaar and Bank Bazaar are platforms that essentially where you go to discover what my next best option is if my bank is not willing to lend to me, right? So I've gone applied to my bank, the bank said no. Now I'm going to figure out what my next best option is. I have no clue which NBFC to go to, which fintech to go to. So I go to Paisabazaar or Bank Bazaar and they sort of help me figure out this is the next best option. Right? What will happen now is any sort of demand side platform that's on ONDC will be able to provide all the supply side options via ONDC and make revenue in the middle, right? So I don't know, right, to what extent it will, can it potentially impact embedded finance? Yes, if those lenders start getting aggressive enough to say, for example, in the rent payment example that I gave, right? If 10 lenders came on and said, look, went to and MyGate figured out that if I can work with these 10 lenders directly to offer rental payment products at zero cost, right, using this protocol, could that disrupt it? Potentially, right? But it is very, very nuanced and it's very specialized, right? Where we have to go in and figure out a lot of things, and we try and make things competitive for MyGate customers, which if I'm a regular consumer or a supplier on the ONDC network, I can't figure out who money is so quickly to be able to make an instant decision about I'll give them a zero cost rental payment product. That may never make money, right? So I think it can and it will disrupt supermarket businesses, right? Supermarkets are your Swiggy, Zomato, Ola, Uber, your courier companies, transport, shipping, to some extent travel, food delivery, etc. Right? Those are all, and even loan supermarkets, right? Because that information is now going to be available first party instead of second party, right? Paisa Bazaar at the end of the day will also show you offers by their own economic incentive.
Correct.
Right. So they will show you, they will not necessarily show you the best offer for you, but they will show you the offer potentially where they will make the most money, right? ONDC can strip some of that away, right? But to what extent can it actually influence embedded finance is something that maybe I just don't have enough of an evolved view on, or time will tell.
See, this triggers another question, right? So say, for example, for your example that what you told, so Snapdeal customers that you are planning to give some respective credit products for the same, say for the first 1 lakh customers, let's take a random example, right? For the Snapdeal's first 1 lakh customers, same similar credit policy, say credit score more than 700, some list of categories. Assume that there are 3-4 lenders are interested to do credit, right? Willing to provide options. Then in that case, how will you give an offer to the customer? Is it if it should be a lender focused or a customer focused, or which on based on which decision that you'll give a offer to the customer?
Yeah, it's a good question. So typically, there are two parts to this, right? There is competitiveness from a product point of view, which is how much money you're giving at what price to and what fees, etc., to the end customer. The second is competitiveness from an experience point of view, right? So I'm sort of taking the second one out of the equation because let's assume that all experiences are the same, right? Which is in the context of embedded finance, everything is super seamless, everything is 10 clicks and money in bank, right? I'm removing the second piece. In the first, typically what you find is customers will only take products. I mean, the hierarchy for acceptance of a product typically ends up starting with loan amounts, right? So saying, am I getting what I need in terms of quantum, right? Because if I'm taking a 3 lakh holiday and only 50K of it is being financed, then it's of no real value to me, right? But if I'm taking 3 lakhs and 2,80,000 is being financed, or 3 lakhs is being financed, then there's some inherent value for me. The second thing that again, and sensitivities on rates differ across the credit spectrum, but given a certain loan amount, given that my need is being satisfied, what is the cost of this product, right? And is it afford? Then after that comes what is the tenure and the EMI burden on me, right? So more than, this is today, it may be a 12% product, but if it's only a 12-month loan, can I afford to pay 12,000 rupees a month in installments? No, then it doesn't work for me. And then you have fees and other things, right? So typically what any, sensible fintech will typically try to optimize for is take rates driven by loan amounts, followed by rates, followed by everything else.
Got it. Interesting. So switching gears, Aditya, I have a lot of questions in my hand, so let's go quickly. So how RBI is seeing all these things? Can you give any light on that, Aditya?
So I think the RBI is, firstly, the regulations have never been more favorable, right? In 10 years that I've been operating the space, this is the first time that the RBI has come out and said non-REs, which is non-regulated entities, i.e. fintechs, can actually, for example, share risk, right, with lenders. That's huge. Second is, it's the first time that they've come out and defined the role of non-regulated entities in the context of, of lending operations. For example, what is a loan service provider, right? What is a digital lending app, right? And so I think the second thing is there is a recognition that non-REs, non-regulated entities, have a significant role to play, right, when it comes to all this. That's the answer that's largely in the public domain, right? What we hear right through the grapevine, through lenders, et cetera, is that the RBI, I think, is broadly speaking, right, very, very allergic to two things, right? Number one, to very high yield loans at very low ticket sizes, right? So typically 36% plus the minute you get into that territory, right? And especially, and I'm saying from an APR perspective, not from a simple headline rate perspective, right? Because lenders will say 36% rate, but they'll charge you a 15% fee for a 20-day loan, right?
Right.
But so one is they're very, very allergic to that, right? And they just hate it, right? They hate it because they consider it predatory. They think that people get into debt traps, and much of that and they, lending practices, the collection practices tend to be terrible, etc., etc. So that's one thing. Second thing that they're really allergic to also is REs, whom they regulate, which are the banks predominantly, not doing their due diligence when it comes to underwriting. Right? They hate the sort of surrogate based underwriting ki, broadly fintech ne bol diya to you're doing it, right? They hate it when they sort of uncover in their audits that lenders or REs are not diligencing every single customer at the time of origination, right? That's the second problem. So, but I think aside from that, right, I think we have one of the most proactive regulators in the world. Incredible at facilitating this kind of thing, and has been encouraging, right? They understand that this kind of activity is happening. They not clamp down on it in any significant way, despite the fact that it's growing super fast. But they clearly call out, right? I don't know if you saw the deputy governor's remarks 10 days back, right? But he said, look, he basically came back and said, oops, sorry, we didn't mean to create panic on the unsecured lending side, right? And everything is under control, including growth and NPA levels. But we are a bit concerned that some lenders aren't doing the diligence that they need to at the time of extending credit to end customers.
Makes sense. Okay. Cool. I think I'll move on to the next one, Aditya. Okay. As we are a bit running short of time. So when you say that, so you said that Snapdeal or MyGate, right? So if everybody started giving line of credit or a credit line, right? So as a consumer, would you think that this is the right option, that our customers will be having some 10 different lines and then making use of it? Does it make sense for a customer's point of view?
So I think it always makes sense to have options from a customer's point of view, right? From a Niro standpoint, obviously at the end of the day, the customer we offer it to is unique, right? So if money happens to be on, let's say, Snapdeal and MyGate and Quaker and Housing, the line is the same. He can't go down and from Niro at least withdraw multiple loans from multiple places. But the concern that you raise is, so from a customer's point of view, it's great, right? Plethora of options, ability to choose, near perfect competition, and somewhat theoretical because not everybody discovers it and not everybody has access. The problem that it's actually causing is what we're seeing in some segments, right? Is credit stacking. So what happens is that today, 5 people have been telling me that I have a pre-approved loan with them, right? And today I know I need, and everyone's offering me, let's say, between 30K and 3 lakhs. And I know I'm desperate for credit. And so what I will do is, in a 72-hour window, before anyone realizes, I will go and take credit from all 5 people, right? And then on an income of like 40K, I'm now servicing 50,000 rupees of EMIs, right? And obviously that's not sustainable, right?
Right.
So that's but again, we only see that this only happens typically in the smaller ticket sizes, right? Where people give 10, 20, 30, 40K loans. And to those segments then who are, sort of unfortunately needy enough to do something like this, right? And don't care about the repercussions. So yeah, from a customer point of view, it can be great, right? Plethora of options, take what's best for you. Markets are getting more sophisticated. But on the downside, unfortunately, especially in some of these marginal segments, what we're finding in lower income segments is, people are struggling a bit sometimes.
Okay. Interesting. And so assume that I'm an internet-based company, right? So I'm having 1 lakh customers. and I'm seeing some 50,000 transactions a month on month, right? So I mean, show me the money, right? So I mean, how will I get additional revenue if I do an embedded finance? And what are the products? Say, assume I'm a travel site that I have, and I'm getting this 1 lakh very small customer base. Less than, I mean, I don't know whether what is small right here. You can also give some suggestions. So what interest Niro, where you will go and have tie up with this consumer internet companies, and how they will get revenue out of it, Aditya?
So, couple of things you can do, right? Let's just take your example. I mean, let's just say you had 100 customers, right? Not even a lakh. But let's say you had 100 customers a month, right? Typically, what you could do is, if you partner with someone like a Niro, what we would generally be able to do is, in a 12-month span, you could distribute 1 to 2 loans, right? And that may seem low to you, but when you figure out that, look, out of these 100 customers, and this can even be non-transacting customers, it can be, these don't have to be people who have done a transaction, but who you have access to, right? So when you actually find out that at the end of the day, I'm being able to generate, let's say, 40 rupees of revenue for every customer that's on my platform, because one loan gives me revenue 4,000 rupees. And if I even do one loan a year on those 100 customers, for all 100 customers, I made 40 rupees, right? 4,000 divided by 100. That's quite substantial, right? Because if you look at your MAU, your regular revenue per active user, you find that that number tends to be extremely low. So that's one. If you just did pure cross-sell credit distribution, in 12 months, for every 100 active customers, you could probably give one loan out. And that could give you 40 rupees of what we call ARPU, right? Average revenue per user, at a platform level. And that's massive. The second way that you could use it is actually, the other one that would be a bit more natural would be for you to find a partner who can finance your checkouts, like a Simple, right? Or a Lazy Pay. Say, look, Simple offers a pay in 3 option. Can I integrate their product? Because that'll actually help my core business.
Right.
Because at the end of the day, if out of 100 people reaching my checkout page, if only 5 are transacting, can I potentially get 7 to transact? Right.
Mm-hmm.
And the 2 that transact using this, checkout, this payment method, will also have larger ticket sizes because you're financing it. So they say, instead of flying to Bangkok, I'll fly to Singapore. Right.
Mm-hmm.
So those would be the 2 biggest ways, I would say, right, that you could probably use it. There is a tail of things, other things you could do: card distribution, sell fixed deposits, try and sell mutual funds, insurance, etc., etc. But from a revenue point of view, right, these are the 2 that really stack up.
Okay, great. Now let's come back to the technology, right? So how technology is helping, because there are different stakeholders being involved. How tech is helping this entire ecosystem, Aditya?
So, I mean, what fintechs are doing essentially, like I said, is they build the core middle, right?
Mm-hmm.
They help design. Tech helps, give the customer a good experience. Tech helps mitigate fraud risk. Tech helps make sure that you're not underwriting bad customers. Tech helps in, providing marketing and context to end users. So tech is really the backbone, right, of everything. It allows lenders to actually come onto your platform without needing to manually look at every single consumer. And it allows the consumer internet platform to promote seamless discovery and sort of completion, right, or fulfillment. So tech is really the backbone of all this.
All right. And the tech, how, in your practical examples, right? So be it a Snapdeal or MyGate, you are integrating with only one lender or multiple lenders, Aditya?
We always have, so we have 5 lenders active at the moment. In the next 6 weeks, we'll be live with 9 lenders. And like I said, in the majority of those partnerships, we do the underwriting, servicing, and collections. But increasingly, what we're trying to do is find lending partners who are willing to actually underwrite the customers on their own risk and do the servicing and collections themselves, where we act as a pure platform.
But see, the one of the major challenge, if I go and talk to the industry, everybody is saying that integrating with the lenders is take up plenty of time because
yeah, man, oof.
Throw light on that, no, Aditya? What is your experience on integrating with these lenders?
It's really hard, man. It's really hard because look, and for good reason, right? Their systems are complex. They're not agile. Their documentation is far from perfect. right? It's never up to date, right? So stuff behaves in ways that it shouldn't. So it's a real project, right? People think, building integrating with lenders is like a, 30-day job. It's absolutely not, right? Average time, I think it takes us from commercial closure to go live is like 3 to 4 months, right?
4 months, is it? Oh, okay.
Yeah. So and that also is just the beginning, right? One part is integrating. Second part is an operationalization, figuring out what's happening. Why are some customers not getting money on time? Where is money getting lost? Collections, recon, settlements, payments. It's a full-time job, right? Full-time job. So yeah, it's incredibly difficult, and therein lies the opportunity, because people can't do it easily, right? So that's why guys like Niro exist, and that's why guys like Credit Avenue exist. They claim to have a bunch of lenders on one side, and they say, look, you just consume my API and my API, and I'll do everything else, right? Again, not as simple as it sounds.
Correct. Yeah. And this, add on to that question, is OCEN helping that? Because this is one of the questions being asked. I'm getting a WhatsApp message asking that. So is actually the problem of all these integrating with these lenders. That is the reason why OCEN has been built. Do you think OCEN will solve this problem, or still we have to deintegrate separately?
Yeah, right. I don't think that's why OCEN has been built. I think OCEN has been built to democratize the access, right? But it, again, fundamentally, it's limited to the pool of credit seekers, right, who are needing a loan, wanting a loan, and therefore going out and looking for a loan and saying, what is my next best option, right? Because everyone goes to their bank first. Only if the bank says no do they look outside, typically, right? So it'll help solve the problem of discovery, right? To what extent will it solve the problem of reducing friction? And it's apples and oranges money, right? Not sure
Okay.
to sort of answer that.
I'll quickly take 2-3 questions from the audience. I think that is another interesting question. Assume that the customer is new to that platform. He's new to Snapdeal, and he's also an NTC customer, right? So how do you actually evaluate that person, Aditya?
Can't. Very few people do it, right? The only guys who can do it is, in fact, I'd go so far as to say, almost nobody would underwrite that customer, right?
Okay.
They would need some data. The guys who would do it, we don't do it at all, because it's impossible to do, right? It's like just blind, close your eyes and open your mouth. It's that kind of strategy. So nobody would underwrite that customer typically,
right.
And neither would we. If one had to put a gun to my head, I would say we'd need the user to download an app, and then that's a broken journey, and lot of rejection post that. So just wouldn't really get into it in a big way.
Okay, got it. And the question from the Umang is, see, the batch processing essentially means that you run in a DRA on the list of customers provided in one go, or it will be a multiple set of iterations, and then these fintechs push this approval amount to the customers. As a fintech is pushing, as the Niro is pushing the offer to the customers, or the Snapdeal is pushing to the customers?
No, the platform. See, if Niro starts doing it, then it doesn't become embedded financing, right? Niro starts doing it, then it becomes D2C embedded lending. D2C non-embedded lending, right? This would always be the platform pushing it to the customer, trying to, like I said, create some sort of context, right? And in that marketing, and then getting the customer to try to come through the journey.
And the first part of the question, like batch processing, is happening in one go, or it will be a multiple iterations, Aditya?
A multiple iterations, because your batch can only be so large, right? Even if your batch is 10 million customers, you'll do it 10 million, 10 million, 10 million, 10 million, then 20 million, 20 million. You'll never do it at, beyond a certain scale. In fact, it's usually much smaller batches, right? Like 2 to 5 million.
Okay. And any scope of GenAI in embedded lending, GenAI and all?
For sure. So GenAI is again super vast, right? So GenAI can help with helping potentially, read things out of unstructured data. It can help with dynamic journeys. It can most certainly help with assisting customers through journeys, right? And they have queries often, and you don't always want to put a call center where customers can call. So it can help them with customer support in real time if they have FAQs on what product, who's the lender, how can I prepay, what's the penalty, is this a reducing rate or a flat rate, what are the fees, what are the late payment charge? Like GenAI can help with all of those things also. So for sure, in various aspects of it, I think the soul of the question probably is, can GenAI help you potentially underwrite better? I think the answer is yes. I think we have yet to figure out how.
Okay, got it. But in future, it'll be for sure, is it?
Absolutely. I mean, AI as a as an umbrella is going to impact everything anyone in the tech world does, right? And even in the analog world does. I think right now the lowest hanging fruits are things like customer support, right? It's now moving up the value chain to say, okay, I can even potentially automate sales for you, telesales, right? So customer needs a warm body on the other side. It doesn't necessarily have to be, right? Like I called United Airlines a couple of months ago, and I was shocked because literally it was an AI powered bot that helped me reschedule my entire flight, right? Through voice, as opposed to or at least got me like 80% through and then connected me to a warm body, basically.
Okay.
So it'll help all of these aspects. I think it can also has the power to help with processing unstructured data and identifying patterns, right? Which is something that people do relatively little of today. But absolutely, man, absolutely. Is it going to like revolutionize how we lend in the near future? Maybe not, but maybe one day.
Great. And on the final note, right? The one last question to you, Aditya. Like, what do you see as a future of embedded lending? If you can tell, okay, these are all the areas that it's going to grow big, or these are all the things that's going to be adapted by the ecosystem. You can throw a few ideas that will be creative.
Yeah. So I mean, I think embedded delivery of contextual products that are both competitive and frictionless, right? That is what I think is going to happen, right? So embedded delivery of contextual credit products that are both competitive and frictionless. What that means, as a couple of examples, is if I'm a super affluent, high credit worthy customer, high credit, like a very, very credit worthy customer, and if I need to pay my rent, I should be able to pay it in 2 clicks at zero cost, for example, right? If I'm a middle income, earning 20 to 50K a month customer with a thin credit history, looking to buy a second-hand bike, for example, I should be able to finance that bike, but maybe not in 2 clicks, and perhaps pay a little bit more interest for it, right? If I'm a new to credit customer, looking to make a productive purchase and looking to make a productive purchase that will boost my income, for example, an MSME, right? But I don't have a formal credit history as a proprietor, and I'm looking to buy a tractor, and because it will help my income, etc. I should be willing to jump through 5 hoops instead of 2, because the middle guy had to jump through, and potentially pay higher fees and suffer on product flexibility a bit to be able to finance that product purchase at the time that I need it, right? So I think in whichever avatar you look at it, right, from an embedded lending standpoint at least, right, customers should have access to contextual products the time that they need them, which are both competitive and frictionless, embedded and contextual products, which are both competitive and frictionless. And you can, think of almost infinite ways in which that can sort of be present.
Thank you so much, Aditya. It was wonderful talking to you. I believe that the audience will definitely get some few insights about embedded lending and embedded finance.
My pleasure.
Wish you best success to your company and your family also, Aditya. Okay.
Thanks, Mani. Thank you so much.
Yeah, thanks, audience. Thanks for joining us in the webinar. And you can also see the YouTube version, and we will also create a blog towards this particular discussion in our website. And we keep conducting a lot of webinars in this digital lending space. Feel free to follow us and then get the latest updates. Thank you so much. Yeah. Bye, Aditya.
Bye, guys.